3, income tax aspects of real estate. So we're going to go over real estate ownership. Real estate ownership has income tax consequences. This unit explores many of these issues. So the unit is going to cover the following topics. So types of income, tax deductions for owner-occupied residences, capital gain exclusions on the sale of a home, tax deductions on income property, tax deferred exchanges, adjusted basis and capital gain calculation, capital losses, installment sales, mortgage over basis, debt relief, step up in basis at death, opportunity zones, and FERPTA. So after completing the unit, you're going to be able to define different types of income, list tax deductions available to homeowners, discuss the exclusion of capital gains tax on the sales of a personal residence. You'll be able to list the deductions available to homeowners of income property, discuss the basis principles and rules of a tax deferred exchange, calculate a property's adjusted basis, calculate a capital gain or loss from the sale of a property, define an installment sale, define mortgage over basis and potential tax consequences, define debt relief and potential tax ramifications, define a step up in basis at death, discuss the step up in basis differences for spouses owning as JTWRS versus community property, explain opportunity zones, their tax benefits and requirements, discuss the Foreign Investment in Real Property Tax Act. Okay, so you're going to have to do some independent studying. I'll go over the unit summary and the unit quiz. All right, so for the unit summary, we're going to go over these key points. So real estate agents should advise clients to seek tax advice from tax professionals. So if you're asking your realtor about tax advice, they should tell you to go to talk to a tax professional like a CPA, a certified professional accountant, or a TA, tax accountant. Ordinary income is income from salaries, wages, commissions, and interest. Capital gain income is income realized from the sale of a capital asset. So if you sell your house, is that income? No, it's a capital gain expense. Right? A capital gain, actually. Passive income is income earned from investments in which the owner, investor, does not manage the investment. Pass-through income is income from an entity, such as an LLC, that passes through to be taxed at the level of the individuals in the entity. Owners of owner-occupied residences and second homes may take tax deductions for real property taxes and other taxes up to $10,000. Interest on loans up to $750,000 used to purchase or improve the property. In the sale of a personal residence, capital gains will be excluded from being taxed up to $250,000 of gain for single taxpayers and $500,000 of gain for married couples. So is it a benefit in being married? Yeah. The benefit is you get $250,000 more in terms of gain, right? So if you sell your house and you sell it for, say, $400,000, then in the sale of personal residence, capital gains will be excluded from being taxed. So say you sell for 400, or say you sell it for 400,000, and you only owe 100. Well, you made 300,000. So that 300 is less than the 500,000, so you don't have to pay capital gains tax. But say you made 600,000, so 500,000 of that is excluded because you're married. So you'd only have to pay capital gain on that extra 100,000. Now, say you were single and you made 200,000 on your house, right? That's how much you gained. Well, you don't have to pay any capital gain tax. But say you sold your house and you made $300,000. Well, now you have to pay $50,000 in capital gain tax because you're single, and it only goes up to $250,000. To qualify for the capital gain exclusion, the residence must have been the owner's principal residence for at least 2 years out of the last 5 years. So here's another caveat. You had to have owned your house for at least 2 out of the last 5 years. So if you owned it for 1 year, do you have to pay your capital gain tax? Yes, right. But if you've been living there for at least 2 out of the last 5 years as a primary personal residence, you don't have to pay capital gain tax. So it's good if you buy a house, live in it for at least 2 out of the 5 years, and when you do and then you could sell it, because then you won't have to pay any capital gain tax. Tax deductions on income property include operating expenses, including all property taxes, interest on all loans, and cost recovery. It's called depreciation, right? Cost recovery. Cost recovery is another term for depreciation. Land or personal residences may not be depreciated. So again, land or personal residence may not be depreciated. So can you depreciate land or a personal residence? No. The depreciable basis is the value of the improvements at the time of purchase. Depreciation recovery period is the period over which the owner may take deductions to recover investment. They are 27.5 years for residential income property and 39 years for non-residential property. So if you own a house and you rent it out, you can depreciate it. And the depreciation period is 27.5 years. What if you own commercial property and you rent that out? You can depreciate that for 39 years, right, for non-residential property. So, for example, I have a property and I rent it out and I depreciate it over 27.5 years. And my CPA, my certified professional accountant, takes all the taxes, does all the tax information. Only straight line depreciation is available for real property, and it is recaptured as ordinary income at time of sale. So again, only straight line depreciation is available for real property. Only like-kind properties qualify for a tax-deferred exchange. So only like-kind properties qualify for a tax-deferred exchange. Like-kind means property held for the production of income in a trade or business or for investment. In a delayed exchange, the replacement property must be designated within 45 days of closing of the contract date. Closing must take place within 180 days of the contract date. So again, closing must take place within 180 days of the contract date. A delayed exchange contract must have exchange language and specify an exchange intermediary. In an exchange, boot is unlike kind property given or taken to balance equities. So again, in an exchange, the term boot is unlike kind property. So if you hear boot, that's not the same, right? Not like kind. The formula to calculate adjusted basis is what? It's going to be acquisition costs plus capital improvements minus depreciation equals your adjusted basis. So adjusted basis is going to be your acquisition costs plus your capital improvements minus your depreciation. That is your adjusted basis. The formula to calculate capital gain is going to be the sales price minus the cost of sale minus the adjusted basis, which is going to be equal to the realized gain minus depreciation, which is going to be equal to the capital gain. So again, capital gain, if you want to calculate capital gain, it's going to be the sales price minus the cost of the sale minus the adjusted basis, which is going to be equal to the realized gain minus depreciation, and that'll give you the capital gain. Capital losses may be used to offset capital gains that occur in the same year. If there are no capital gains to offset, $3,000 in capital losses may be used to offset ordinary income. Remaining capital losses that have been carried forward may be used to offset future capital gains. An installment sale is a sale of property in which the seller receives at least one payment after the tax year of the sale. Mortgage over basis may occur by refinancing a property that has been appreciated over time. Because of a property has been depreciated to a point at which the basis is lower than the mortgage balance, it's going to be mortgage over basis may occur. If a property that has mortgage over basis is sold, the amount of mortgage over basis may be taxed as ordinary income. If a lender forgives some or all of a debt, such as in a short sale, right? Short sale, you have more debt than what is valued. Then the bank, if you miss 3 payments, you go into foreclosure. So then they put on a short sale. Sometimes if the bank accepts that, if a lender forgives some or all the debt, such as in a short sale, the amount of debt relief may be taxed as ordinary income. So again, this where the lender is kind of, so you say you owe 200 grand on a house and it's only worth 100 grand. Well, in a short sale, the lender is going to forgive your debt, some of the debt, so that they can recover what you owe. If spouses hold property as JTWRS, at one spouse's death, the surviving spouse receives a step up in basis only on the decreased spouse's behalf. If spouses hold property as community property, at one spouse's death, the surviving spouse receives a full step up in basis. An opportunity zone is an economically distressed community where new investments may be eligible for preferential tax treatment. FIRPTA, right? It's called FIRPTA is Foreign Investment in Real Property Tax Act, requires tax to be withheld when a non-resident alien sells a property. Number 1, if money is not withheld from the proceeds from property sold by a non-resident alien, who may be held liable for the tax? So bravo, it's the buyer. So the buyer again, if the money is not withheld from the proceeds from property sold by a non-resident alien, who may be held liable for the tax? It's the buyer. So escrow, no. Broker, no. No one, no. In reviewing an offer, the buyer asks the agent about the tax consequences. The agent should, bravo, suggest the buyer see an accountant or tax attorney. So suggest the buyer see an accountant or tax attorney. So in reviewing an offer, the buyer asks the agent about tax consequences. So, you're gonna get an offer, and then your client asks you about taxes, right? You have fiduciary duty. So your fiduciary duty is to advise them that you're not a tax person. They should seek tax assistance from a tax professional, such as a CPA, certified professional accountant. So the agent should suggest the buyer see an accountant or tax attorney. So gave the offer reviewed by an estate planner? No. Prepared the offer with a tax contingency clause? No. Have the broker review the offer? No. Number 3, what is the max amount of capital gain that a married couple can exclude from the sale of a principal residence? Charlie, $500,000. So, it's $250 for single, $500 for married. So it is C, 500,000. So what's the max amount of capital gain that a married couple can exclude from the sale of a principal residence? Of 500,000. To qualify for the exclusion of a capital gain tax on the sale of a personal residence, Delta, the seller, must have owned and lived in the house for 2 out of the previous 5 years. 2 out of the 5 years. So the seller must have owned and lived in the house for 2 out of the previous 5 years. So to qualify for the exclusion of capital gain tax on the sale of a personal residence, seller must have owned and lived in the house for 2 out of the previous 5 years. So that's Delta. So A says seller must purchase another property of equal or greater value. No. Seller must be over 65. No. All proceeds must be reinvested in another home. No. Which ownership method would give a surviving spouse a full step up in basis to current market value at the death of the other spouse? Bravo, community property with right of survivorship. So community property with right of survivorship. So which ownership method would give a surviving spouse, right? Keyword here is surviving, right? Survivorship. A full step up in basis to current market value at the death of the other spouse. So this would be community property with right of survivorship. So joint tenancy with right of survivorship? No. Tenancy in action, tenancy in common? No. Ownership by a family trust? No. Number 6, 3 years ago, an office building was purchased for $1.5 million. The owner has made $250,000 in capital improvements and has depreciated the improvements a total of $175,000. What is the owner's adjusted basis? It is C. So you're going to have to do some math on this one. 1.575 million. 1,575,000. That's the owner's adjusted basis. Unlike kind of property received or given in an exchange is what? It is boot, right? Boot, talk about this. Boot is unlike kind property. So, often you have to do like kind, but if you have an unlike kind, they call it a boot. Boot is unlike kind property received or given in an exchange. Is it called excess rent? No. Net income? No. Cash flow? No. Income from the sale of an asset held for more than 1 year is what? Bravo, long-term capital gain income. Long-term capital gain income. So income from the sale of an asset held for more than 1 year is long-term capital gain income. So if you get income from the sale of an asset for more than 1 year, that's long-term capital gain income. So is it short-term? No. Ordinary income? No. Passive income? No. In the same year, a taxpayer has long-term capital gains totaling $150,000 and capital losses of $125,000. The taxable capital gain income for the year is what? Bravo, $25,000. So you're going to need to do some math on this. On a personal residence, what is the maximum loan amount on which interest may be deducted for tax purposes? C, $750,000. So on a personal residence, what's the maximum loan amount on which interest may be deducted for tax purposes? $750,000. Which of the following is correct regarding tax deductions on investment property? B, land is not able to be depreciated. So which of the following is correct regarding tax deductions on investment property? Land is not able to be depreciated. So land is not able to be depreciated. You can't, land or personal residence, you can't depreciate that on tax deductions. On investment property, personal property is different. You can, but investment property, there's no tax deduction. Typically, there's no tax deduction on investment property, anyways. So A says no deduction is allowed if the property is appreciating. No. The cost and basis of the entire property may be depreciated. No. Only the value of the land is able to be depreciated. No. 12. When an investment property is sold, any depreciation the seller has taken as a deduction over the period of ownership is what? Charlie, recaptured and taxed as ordinary income. Recaptured and taxed as ordinary income. So when an investment property is sold, right, it's investment, any depreciation the seller has taken as a deduction over the period of ownership is recaptured and taxed as ordinary income. So this one throws everyone off, right? Because they think, oh, when I'm depreciating it, right? Again, this doesn't apply to a personal property, right? It's an investment property. But if you have an investment property, that's why it's important to tell your tax person up front, is this investment or is it personal? Personal, this doesn't apply. But on an investment, you think, oh, you're going to depreciate and you're going to save money. It'll be recaptured when you sell it, and it's going to be taxed as ordinary income. So say you depreciated $100,000 over like 10 years and you sell it in 11 years. Well, that $100,000, you're going to be taxed on that as ordinary income. So when an investment property is sold, any depreciation the seller has taken as a deduction over the period of ownership is recaptured and taxed as ordinary income. So it's not like you get to save your taxes, for those 10 years, where you were depreciating. No, they add up all those depreciations over those years, and then they tax that as ordinary income. A says recaptured and taxed as a short-term capital gain. No. Recaptured and taxed as a long-term capital gain. No. Net recaptured but taxed as a long-term capital gain. No. It's going to be recaptured and taxed as ordinary income. A homeowner may claim a tax deduction for depreciation if the home is a alpha rental, right? So rental, a homeowner may claim a tax deduction for depreciation if the home is a rental. Again, a homeowner may claim, right? Like me, I'm a homeowner and I may claim a tax deduction for depreciation if the home is a rental. So again, my home is a rental, and I've been able to claim it as a tax deduction. B, owner occupied dwelling, no. Second home, no. Owner occupied manufactured home, no. The federal law that requires non resident aliens to pay tax on gains from the sale of United States property is what? Bravo, FERPTA. So FERPTA, right? The federal law that requires non resident aliens to pay tax on gains from the sale of U.S. property is FERPTA. So what is FERPTA again? Let's go back. FERPTA is Foreign Investment in Real Property Tax Act. FERPTA is Foreign Investment in Real Property Tax Act. So FERPTA is that foreign tax act where a foreigner owns property and they sell it in the United States and they make a lot of money. Well, they're going to get a FERPTA tax, right? So FERPTA is going to require tax to be withheld when a non-resident alien sells a property. So they don't live here in the United States. They live in, say, like China, and they own property in America, and they sell it, and they make a lot of money, or they make money. Then the FERPTA Act taxes them, requires tax to be required when a non-resident alien sells a property. So the federal law that requires non-resident aliens to pay tax on gains from the sale of U.S. property is FERPTA. Is it RESPA? No. TILA? No. ECOA? No. A homeowner determined that the following expenses has been sustained due to home ownership. The principal paid was $871. The interest paid was $5,200. Property taxes was $900. Insurance was $350, and repairs was $155. Which of the following items would be deducted from the homeowner's federal income taxes? So it'll be C, interest and property taxes. Interest and property taxes. So which of the following items would be deducted from the homeowner's federal income taxes? So again, we talk about PITI, P-I-T-I, principal interest taxes in income. So interest and property taxes, the P and the I, principal, P-I-T-I, principal interest taxes, interest. So is it principal interest? No. Property taxes and insurance? No. Oh, PITI is principal interest tax insurance. Sorry. Interest and property taxes? Yes. Interest and repairs? No. Income from salaries or commissions is what? Ordinary income. Ordinary income. So income from your salary, right? We call it as ordinary income. Ordinary. Typically, right? You go to a W-2 job, you make that income, ordinary income, right? But what if you're a realtor and you make a commission? Ordinary income. So, or if you're an independent contractor, you're making that's your ordinary job, that's ordinary income. Is it short-term income? No. Capital gain income? No. Pass-through income? No. Number 17, when a limited liability company has net income, LLC has net income, what happens? Bravo, the income passes through to the individual members. The income passes through to the individual members. A sale of property in which the seller carries the financing and receives at least one payment after the tax year of the sale is what? Charlie, installment sale. Installment sale. So, installment sale is a sale of a property in which the seller carries the financing and receives at least one payment after the tax year of the sale is called an installment sale. Sometimes also called a like seller carryback sale or installment sale. Seller carryback, installment sale, same thing. Seller carryback, installment sale. Tax deferred exchange, no. Capital gain transaction, no. Lease option purchase, no. All right, property with an adjusted basis of 1.75 million, sold for 2.5 million at the end of the 5 years. If the cost of sale 160,000, what is the owner's capital gain? What's the owner's capital gain? It is alpha 590,000. So you're going to do some math for that. All the following are potential benefits or requirements of investing in a property located in an opportunity zone, except what? B. Charlie, except the investor must invest 100% of acquisition cost within 12 months of purchase. So the investor must invest 100% of acquisition cost within 12 months of purchase. So that is not a potential benefit, or that is not a requirement of investing a property located in an opportunity zone. They do not have to invest 100% of acquisition costs within 12 months of purchase. How about A, tax deferral on capital gains received from the sale of other investments? Yes. Reduction in the amount of taxable gains tax. Reduction in the amount of taxable capital gains, yes. Any appreciation of the opportunity zone investment is non-taxable if the property is held for at least 10 years. That's true. 21, the loan amount on an owner's personal residence. The loan amount on an owner's personal residence is higher than the owner's adjusted basis. If the property is sold, the difference is, bravo, may be taxed as ordinary income. So again, we're talking about investment property, right? The loan amount on owner's, we're talking about personal residence. So the loan amount on an owner's personal residence is higher than the owner's adjusted basis. If the property is sold, the difference may be taxed as ordinary income. So bravo, may be taxed as ordinary income. Alpha says may be taxed as capital gain. No. Is recaptured as capital gain income? No. Will not be taxed because it is a personal residence? No. It may be taxed as ordinary income. 22. The value of the buildings at time of purchase of an investment property is, bravo, depreciable basis. Depreciable basis. The value of the building at time of purchase of an investment property is depreciable basis. The value of the building at time of purchase of an investment property is depreciable basis. The value of a building, the value of the building. So the value when you buy it, the value of the building when you buy it is of an investment property is depreciable basis. So, this is a common one people get wrong. So depreciable basis is when you first buy your building, and it's got to be an investment property. That's called the depreciable basis that first time. Is it an adjusted basis? No. Investment basis? No. A basis at sale? No. Income earned from investments in which the owner investor does not manage the investment is delta passive income. Passive income. So income earned from investments. So when you earn money from your investments in which the owner or the investor does not manage the investment, right? The owner or the investor, they don't manage it. What's that called? That's called passive income. So the owner, he's got like 10, say for example, he's got like 10 commercial properties and they don't manage it. They own it, but they don't manage it. That's passive income. Passive income. Is it pass-through income? No. Ordinary income? No. Earned income? No. Passive income. Passive income is an owner or investor. They own 10 or 20 properties. They don't manage it, and they just get the money. It's called passive income. Okay, so we'll go over Unit 34 next, which is mortgages, deeds of trust, and foreclosures.